So IFRS 2, share-based payment. As the name suggests, share-based payment means share-based payment, right? So we are paying people based on the value of the shares of the entity. So let me go into my slide. So again, coming in from the book, this is in volume 1, IFRS 2. You can check the content and then look at it in that particular case. So what is the idea about share-based payment? Simple. Let's say that an entity has bought goods. Okay, so purchase of inventories for $10,000 from a supplier. Normally, when we buy inventories, it means that we've bought inventories, so you pay with cash. But sometimes the deal will be structured that, hey, we don't have money to give you, but we will pay you at some time in the future based on the value of our shares. That is the idea about share-based payment. Or employees have worked, and we are supposed to give them money, but we said, hey, we're going to pay you based on the value of the shares of the entity. That is the idea about share-based payment. That's all. So unlike compensation of employees in IAS 19, as we discussed a moment ago, where we're giving people cash, here we are paying people based on the value of the shares of the company. That's why it's called share-based payment. And so generically, there are 3 types of share-based payment, and the way we account for them is also different. So you have to be mindful. So number 1, we have what we call equity settled share-based payment. So this is where we are just paying somebody based on equity shares. That's all. So you're not going to get money. So hey, supplier, we won't give you $10,000 cash. We'll give you $10,000 worth of equity shares in our business. That is called equity settled share-based payment. For employees, that usually will be referred to as share options. And we'll come back to that in a moment. That will usually be referred to as share options. So instead of giving you the money, we'll give you equity shares in our company. 2, cash settled share-based payment. Cash settled. So here, we will give you cash, but the money to be given to you will be dependent on the value of the shares of the entity. So based on the price or value of the entity's shares or other equity instrument. That's the second one. And to employees, usually that will be called share appreciation rights. And we'll come down to that in a moment. So we will give you money though. So hey, supplier, guess what? We'll give you some 10K. Yeah? But the money we'll be giving you will be based on the value of the shares of the company. And we'll come back to that in a moment. The third type of share-based payment is where the third party in question has the right to choose between either they will get money or they will go for equity shares. That's the third type. Transactions in which the entity receives or acquires goods or services, and either the entity or the supplier has the choice as to whether the entity settles the transaction in cash or by issuing equity shares. Stay with me carefully. That third part requires that it will be treated as a compound financial instrument in accordance with IAS 32 financial instrument presentation. So we must split it between debt component and equity component. It is like we are issuing convertible loan notes. So let me take it again. Let's start the discussion from the third type of share-based payment. So type 3 share-based payment, and we are looking at where the third party has an option to choose either cash or equity shares. So here, what we are saying here is that supplier, listen, we are buying inventories of 10K. We don't have money now, but we have a deal for you. 3 months from now, you can get some money based on the value of the shares of the company, or you can acquire some shares in our company worth $10,000. That is what we are talking about. So the third party has an option to choose between cash or equity shares. So let's look at the accounting treatment for this. So this transaction or this type of share-based payment is treated in accordance with the principles in IAS 32, financial instrument presentation. What does that mean? It means the fair value of the transaction must be divided, not dividend, divided into both equity and debt components. That's what I'm talking about. So we treat this like we would treat issue of convertible loan note. You get the idea? Like we would treat issue of convertible loan note. So how do we deal with it? Simple. Journal entry. So what the heck did we buy? Maybe we bought an asset or it is an employee we are paying. So either we debit profit or loss, or we are debiting an asset because we bought an inventory or a PPE. We have to credit equity and credit liability. Okay, so this is where the principle shines. What is the liability? Simple. The liability component is the cash option of the transaction. So if the person is taking money, how much we will pay the money? That is the liability component. So this is the cash settlement option. So if we were paying the person, how much money will we give to the person? That is the liability component. So the balancing figure becomes the equity component. This is initial measurement. So we've bought from you. We owe you $10,000. But guess what? You have two options in 3 months' time. Get your $10,000 or get some equity shares. All right. How should we account for it in our books? Initial measurement. The standard says that this should be treated as a compound financial instrument in accordance with IAS 32 financial instrument presentation. How do we do that? It means we must split the transaction into debt and equity. So whatever we bought, whatever we are supposed to do, which is if it is a service, an employee has rendered a service, then we debit P&L operating expenses. But if we bought inventories from you or PPE from you, then we debit the asset. Now, the money we owe you must be split into debt and equity. What goes into the liability part is the cash settlement option in the deal. Remember, the cash settlement option is based on the value of the shares at the date of the transaction. Okay? So probably let me add that. Based on the value of the shares at the transaction date, then the balancing figure becomes the equity option. That is the initial measurement for type 3 share-based payment.
Nhyira, sir.
Yeah?
If I understand you correctly, it means after we have bought the asset, we are going to we are giving the customer two options, right? To pay part in cash and the other part in equity.
No,
Right.
no. The whole money we owe you will be settled either in cash at some time in the future based on the value of the shares of the company, or you get equity, ordinary shares. So it's not part. It's two options. You either go for cash based on the value of the shares of the company, or you go for equity shares when it is due for you to make your decision. Does that make sense?
Okay.
So it is either or, not partly.
Oh, okay. So if it is either or, then why the treatment of, because in the treatment we have equity
And
portion and then cash. Yes.
Yeah, because any transaction where it's possible people get equity shares in the future is accounted for in accordance with IAS 32 financial instrument. We don't know what the person will do, but since they have a right to get some equity shares, we must recognize that equity component pending what happens when the person exercises their option later on. So that is the idea. So the reason we are splitting between equity and debt is because of the fact that inbuilt in the transaction, the person is likely to get equity. We don't know whether the person will take his money or take the equity. But IAS 32 says it's a compound financial instrument because it has both equity component and debt component. And hence, we split it into the two. That's the rationale behind what we are doing. Is that clearer for you in that case?
Yes.
Okay. On subsequent measurement, what do we do? Stay with me carefully. You learned in your MBA or ICA level 2 under IAS 32 that the liability should be carried at amortized cost. When you get here, kill that idea. We don't carry the liability at amortized cost. The liability component will be remeasured based on the fair value of the shares of the company. So here we won't carry it at amortized cost. When we are doing IAS 32 proper, the liability component will be carried at amortized cost. But when you're in share-based payment, the liability component is not carried at amortized cost. Why? Because the initial measurement, you measured it based on the value of the shares of the company. So on subsequent measurement, it is the same thing we do. Because remember, we will pay the person based on the value of the shares of the company. See how beautiful it is? Yeah, that's it. So subsequently, the liability component is remeasured at the fair value of the share price. Okay, at the fair value of the share price. And then in that case, what happens is that any fair value gain or loss will be recognized in the P&L account. Any fair value gain or loss is recognized in the profit or loss. We are done. Oh, Nhyira, so what happens to the equity component? It will still be carried at the initial measurement value until the date where the supplier or the third party makes his decision. Then we will know the fate of that figure. That's all. We are done. That is share-based payment type 3. When the third party has an option to get either cash or equity shares. So let's crunch some numbers so you see how the principle plays out. We go to the question kit. Page 57 of the question kit. Tano company. We're going to use this as a guinea pig to help us to understand what is going on in that particular case. Please stay with me carefully here because I'm going to crystallize the principle and tell you a story. Very beautiful story. Demonstrate with suitable calculations. Again, demonstrate with suitable calculations. You got to write some English here. You have to write some English here. Demonstrate with suitable calculations how the arrangement should be accounted for in Tano Company's financial statement for the year ended 30th June 2019 for 6 marks. Let's see. Tano Company Limited, Tano Company, a listed company, purchased a significant item on 1st January 2018. If the year ended is 30th June, then 1st July 2018 is the beginning of the year. The list price of the equipment was 12 million. Although the supplier also always gives a 10% discount on its list price. Okay. So how much did we really pay? We didn't pay 12 million. We paid less than 12 million. So fair value of the plant that we bought or equipment that we bought. Okay, fair value of equipment, which is the same as the cost of equipment to us as a company. We got a discount of 10%, so we'll take 90% of the 12 million. I don't know, we could tell the examiner we like to work 3 zeros up. If we do, can I have an answer coming in? 12,000, 90% of that. What do we have? 90% of 12,000. 10,800.
10,800.
Okay. So now, let's proceed to read. Tano was unable to finance the purchase outright, and the supplier therefore agreed to accept an arrangement whereby the amount of payment will be determined by the thing is Tano, and I'm talking about the thing is Tato, and I'm saying Tano. Oh God, Nhyira. Total share price on 30th June 2020. So this is like in 2 years' time. Let's go. So they said we can't finance, so they will take a payment based on the share price. Okay. Now, so if you end there, your brain may be thinking that we are dealing with type 2 share-based payment. Cash settled share-based payment, because they said you get payment based on what? The share price of the entity. But let's proceed to read, because we will now know that it is type 3. On 30th June 2020, under the terms of the agreement, the supplier can choose to receive. The supplier can choose to receive either cash equal to 500,000 of Tato's shares on that date, or 540,000 of Tato's share on 30th June, provided that they cannot be sold for 1 year after that date. So now we know we are dealing with type 3 share-based payment. The supplier has an option to choose either of the two. So quickly, who do we call on? We call on IAS 32, financial instrument presentation, compound financial instrument. We have to split the 10,800 between equity and debt. So let's follow the principles. What did we say? We got to debit PPE, as we mentioned. So initial measurement and recognition. Initial measurement and recognition. We bought an equipment, so we're going to debit equipment with a 10,800. Now, we need equity. We need liabilities, or the liability component. Go back to the rules. What did we say? We said the liability component is the cash settlement option, and that is based on the value of the shares at the transaction date. Principle. So let's go back to Tato. What is the cash settlement option? They said cash equal to 500,000 of Tato's shares. Okay. So if I come back, my liability is going to be 500,000 multiplied by what? Value of the shares at the transaction date. Go back. Tato's share price was 19.8 on 1st July 2018, which is the transaction date. So 19.8. Can I have an answer coming up? Since we are working 3 zeros up, you can do 500 by that figure. 9,900. Okay. So that's our liability component. So your balancing figure from the 10,800 becomes the equity component. What do we have?
900.
900. Is it difficult? That is initial recognition and measurement. Principles. Principles. It doesn't change. That's the rule. You get it, you read the question, you apply it. But we're not done, right? So subsequent measurement. Because we are working for the year ended 30th June 2019. So stay with me. What did we say about the liability on subsequent measurement? We said the liability component is remeasured at the fair value of the share price, so that any fair value gain or loss is recognized where? In the P&L. So on subsequent measurement, which is 30th June 2019, what will be the liability now we owe the person? Still 500,000 shares, but what is the share price now? 20.4 Ghana cedi. Okay, yeah, I'm writing Ghana cedi. I thought I was doing something else. So 20.40. We work in 3 zeros up, so you can do 500 by that figure. 10,200, okay. So this is how much we owe the person now, liability. But we need to get a difference between the initial measurement and subsequent measurement, and that will be increase in liability is a loss. So it will go to the P&L. So loss, fair value loss, which will be recognized in P&L, will be 10,200 minus what we got, 9,900 What am I getting? 300. Okay. That goes to the P&L. So I can pass a journal entry here to say that we debit profit or loss. Because the liability has gone up, it's a loss. And then we credit the liability with a 300. This is how we deal with share-based payment where the third party has an option. We're done. You let me extract financial statement for you, because some of you, you're like, oh, Nhyira, I want to see how the financial statement will look like. I got you. Let's extract financial statement. P&L extract. So in the profit or loss, what we got? We're going to just have the fair value loss. Okay. That's the only thing. The 300 is an extract, so leave it like that. In the statement of financial position, now we assume there is no depreciation charge on the asset, right? So we'll still carry it at the amount. So under non-current assets, we'll have equipment. The money we paid, 10,800. Okay. Now, the difference between the 12,000 and 10,800 will not come anywhere in our books, because that is trade discount. That's all. It is early settlement discount that comes in the P&L, which is a discount received that will come in the P&L. This is quantity discount or bulk purchase discount, so it doesn't come anywhere else in the financial statement. So we go to equity and liabilities. So under equity, you're going to bring in the equity in relation to the share-based payment. We got 900. So normally that will come under other components of equity. So let me write the right thing. So other components of equity in terms of the share-based payment, 900. Then liability. Now, when is this thing due? How long do we have to go? We bought in 2018. The person can redeem in 2020. That's 2 years. We've done 1 year, so we have 1 more year to go. So that will come under current liability. Classification is important, okay? So under current liability, we're going to have the share-based payment, which is the remeasured amount, 10,200. So this is the answer to the question, inclusive of explanation, because it says demonstrate with suitable calculation. Demonstrate with suitable calculation. Demonstrate with suitable calculation. So English must come along with the calculation, the verbs, and what you must do. That is type 3, share-based payment. So slide 1 on that. And then slide 2, the financial statement. And you are doing all of these for how many marks? This was 6 marks. So 1.8 times 6, like 11 minutes-ish. And that is inclusive of reading it, doing the calculations, and writing the English alongside.